Let's talk about a number you probably haven't seen, a 250% surge. In the last quarter, reported physical demand for silver from industrial and investment buyers globally surged by that amount, 250%. Yet the price you see on your screen, the one quoted on every financial network, did not reflect that. It stayed within a narrow band. It even dipped. This is not a minor discrepancy. This is the central fault line in the global silver market. A chasm has opened between what is happening in the real world with real metal and what is being shown in the digital world of paper contracts. For years, people have spoken of a squeeze, of a shortage. What we are seeing now is not a theory. It is a documented physical fact. The bounce back in real, tangible demand is here. It is measurable. And it is highlighting a hidden imbalance so vast that the system designed to conceal it is beginning to groan under the pressure. To understand why this 250% surge matters, we must first understand the official action, the official price, the one you see on Kitco or Bloomberg. That price is not set in a bullion shop. It is not set by a miner selling his concentrate. It is set in a very specific place through a very specific mechanism. For decades, the benchmark price for silver has been established in the paper futures markets, primarily on the COMEX in New York. This is a market of contracts, promises to buy or sell silver at a future date. The vast majority of these contracts are never intended to result in the delivery of an actual silver bar. They are financial instruments used by banks, hedge funds, and algorithms to hedge risk, to speculate, or to balance portfolios. This market is immense in notional value. Billions of dollars worth of silver trades every single day. But the critical word is notional. It represents a claim on silver, not necessarily the silver itself. The official price is discovered here, in this electronic arena, through the continuous trading of these paper claims. This price then becomes the reference point for the entire world. It sets the value for mining company revenues. It influences jewelry prices. It becomes the spot price that your local dealer uses as a baseline. This system exists for a reason. It provides liquidity. It allows for price discovery, in theory. It lets a solar panel manufacturer lock in a future price. But this official action, this endlessly quoted number, has one fundamental requirement to maintain its legitimacy. It must, at least at the margins, remain connected to the physical reality of the metal it claims to represent. The paper price must be able to converge with the physical price when it matters most. When someone stands up and says, "I want the metal, not the money." The 250% surge in physical demand is a direct test of that connection. It is a real-world event asking a very simple question of the paper market: can you deliver? Now we come to the core of the story, the contrast. On one side, we have the paper market we just described, a realm of electrons, leverage, and speed. Here, the price is a flickering number. It can move 5% on a rumor, on a piece of economic data, on the whims of a trading algorithm programmed to follow the dollar index. In this world, it is perfectly logical for the price to fall, even as reports show physical demand exploding. The algorithms are not reading those reports. They are reading interest rate expectations, currency flows, and broad commodity indices. They trade silver as a ticker symbol, SILV, not as a physical commodity with a supply chain. They can sell what they do not have in quantities that do not exist in material form. The leverage ratios are stunning. For every single ounce of registered silver, the kind specifically available to back these paper contracts, sitting in a COMEX vault, there are over 350 paper ounces claimed in the futures market. The paper market is a giant, towering skyscraper built on a very small physical foundation. It is efficient, it is liquid, but it is abstract. On the other side is the physical market. This market is slow, heavy, and tangible. Here, silver is not a ticker. It is an element with an atomic number of 47. It is a coil of wire for a solar cell. It is a flake of paste on a semiconductor. It is a 1,000-ounce bar in a vault, cold and dense. In this market, you cannot sell what you do not possess. A dealer cannot hand you a promise of a coin next week. He either has it in the safe or he does not. When demand in this physical world surges by 250%, things happen that the paper market ignores. Wait times stretch from days to weeks. Premiums, the extra cost you pay over the spot price to get the actual item, balloon. A coin that once cost $2 over spot now costs $8. A 1,000-ounce bar becomes difficult to source at any price. The physical market operates on logistics, shipping containers, armored trucks, assay certificates, and inventory ledgers. It cannot be spun up or down with a keystroke. The 250% surge hit this physical system like a wave, and the system responded with the only signals it can: longer delays and higher premiums. The paper market, meanwhile, with its focus on financial narratives, barely flinched. This divergence is the smoke. It tells us the two systems are no longer moving in lockstep. The map is no longer matching the territory. So where is the metal? The evidence is in the vaults. The supply side data is a ledger, and it is telling a clear story. We must look at the inventories that are meant to be the link between the paper promise and the physical reality. The COMEX exchange, the heart of the paper pricing mechanism, has a system of vaults. Within these vaults, silver is categorized in two key ways: registered and eligible. Registered silver is the working inventory. It is sitting in a vault, has been assayed to exchange standards, and is ready to be delivered to satisfy a futures contract. It is the ammunition for the delivery process. Eligible silver is also there, but it is not posted for sale. It is storage. Think of registered as the items on the store shelf. Eligible is the stock in the back room, owned by someone who might not want to sell. For years, analysts have watched the registered category. This is the critical buffer. When this number falls, it means the visible deliverable supply is shrinking. As physical demand has surged, this registered inventory has not grown. It has, in fact, trended down. From levels over 120 million ounces years ago, it has often dwelt well below 40 million. Recently, it has hovered around 30 million ounces. Simple math highlights the tension. 30 million ounces of deliverable, registered silver. Against that, the paper market has open interest representing obligations for hundreds of millions of ounces. The vault data shows another trend: consistent outflows. Month after month, more metal leaves the COMEX vaults than arrives. It is a slow, steady drain. Where is it going? It is moving into private non-bank vaults. It is being shipped to satisfy industrial contracts in Asia. It is being converted into retail products like coins and bars for investors who take delivery and never bring it back. The vault is being depleted to feed the 250% surge in real demand. This is not a secret. The data is published weekly. The trend is unambiguous. The physical buffer that gives the paper market its credibility is thinning. The cupboard, while not bare, is visibly less stocked at the very moment the world is coming to dinner with a much bigger appetite. Why would the institutions that dominate the paper market allow this disconnect to persist? What is their motive? It is crucial to approach this neutrally without ascribing malice. Institutions operate within a framework of incentives, risk management, and profit. The banks and large financial players in the silver market have several roles. They provide liquidity, making it easy for others to trade. They facilitate hedging for industrial clients. They also take proprietary positions, trying to profit from price movements. Their motive is not necessarily to suppress or elevate the price in a grand conspiracy. Their motive is to manage their own book profitably and with minimal risk. In a market with a huge paper leverage over physical, an opportunity exists. If the paper price can be influenced by factors unrelated to physical scarcity, like dollar strength or interest rate trades, a large player can profit from those moves. They can establish short positions in the vast, liquid paper market based on financial forecasts. As long as the physical shortage remains just that, a shortage of bars, not a runaway price, this can be a sustainable trade. The physical tightness reveals itself in premiums and delays, not in the benchmark price they use to mark their books. Furthermore, these institutions earn fees on the churn of paper contracts. A volatile, liquid paper market generates more commission flow than a stagnant one. Their business model is built on the paper derivative, not the physical metal. Their motive is to keep the paper game functioning smoothly, because that is where their revenue and risk management tools reside. A sudden, violent convergence of the paper price with the physical reality, a short squeeze of historic proportions, would be massively disruptive to their models. It would force them to buy back paper shorts at soaring prices or scramble for physical metal they do not have. So their inherent motive is stability within the paper paradigm. They are incentivized to use their size and market presence to dampen volatile upward spikes that could break the link and trigger a physical delivery panic. They are not necessarily hiding the 250% demand surge. They are simply operating in a different realm, the paper realm, where that surge is just one data point among many, and often not the most influential one for their algorithmic trading strategies. Their actions are a reflection of their environment, a digital marketplace where silver is a financial variable, not a physical commodity. Watching this unfold is uniquely challenging for the individual, the retail investor. Your psychology is wired differently from the institutional algorithm. You see the headline, 250% surge in demand. You feel the intuitive logic. If demand skyrockets and supply is tight, the price should rise. You call your dealer and hear the high premium and the wait time. You confirm the physical reality. Then you look at the screen. The spot price is dormant, or worse, it dips lower. This creates a cognitive dissonance, a deep frustration. You feel like you are seeing a truth that the broader market is ignoring. This can lead to two emotional traps. The first is doubt in your own analysis. You begin to think you must be wrong. If the market price isn't reacting, the experts must know something you don't. Maybe the surge is temporary. Maybe the data is flawed. This doubt can cause you to walk away from a position just before the fundamentals finally assert themselves. The second trap is impatience, leading to overleverage. To prove your thesis right, you might be tempted to use options or futures contracts to amplify your gains, expecting the price explosion to happen tomorrow. But the paper market can remain irrational far longer than you can remain solvent with leveraged bets. The market's indifference to the physical reality feels like a personal taunt. It tests your conviction. The empathetic truth is this: you are not crazy. The data you are seeing from the physical world is real. The disconnect you feel is real. Your psychology is rooted in the tangible: supply, demand, and a finite resource. The market's current behavior is rooted in the intangible: interest rates, currency markets, and derivative mechanics. You are looking at the same asset through two entirely different lenses. The mental battle is to understand both lenses without letting the noise of the paper lens shake your understanding of the physical one. It is about holding two conflicting truths in your mind: that the paper price can be wrong for a very long time, and that eventually the physical reality is the final arbiter. This waiting period, this disconnect, is the hardest part. It requires a patience that the digital trading world is designed to destroy. Given this standoff between a roaring physical market and a quiet paper market, where do we go from here? We can think about scenarios, not as predictions, but as narratives of how this tension might resolve. No single path is guaranteed. Scenario 1. The gradual convergence. The paper market slowly begins to acknowledge the physical data. The sustained high premiums and inventory draws become too persistent to ignore. Buying from industrial users, who are price insensitive because they need the metal for production, begins to seep into the paper market as they hedge future needs. Large investment funds, studying the same vault data and demand reports, start allocating capital to physical-backed ETFs or the futures market itself. The price begins a grinding, volatile, but upward trend, closing the gap between paper and physical. The 250% demand surge gets priced in, but over months, not days. Scenario 2, the continued divergence. The financial narratives of a strong dollar and high interest rates continue to dominate algorithmic trading. The paper price remains suppressed or range-bound. The physical market gets tighter and tighter. Premiums become permanently elevated. A two-tier market solidifies, one price for paper silver and a much higher effective price for actual metal. The system adapts to a permanent disconnect, with the COMEX price becoming less relevant for physical transactions, replaced by other benchmarks or direct negotiated prices. The link is not broken with a bang, but with a whimper, as the physical world simply goes its own way. Scenario 3, the catalyst event. Something triggers a rupture. It could be a major industrial user failing to secure metal through normal channels and entering the futures market to demand immediate delivery. It could be a sovereign wealth fund announcing a major physical accumulation. It could be a moment where the open interest for a futures contract delivery month vastly exceeds the available registered inventory. In this scenario, holders of paper shorts are forced to buy back their contracts at any price, or attempt to source physical metal in a frantic, expensive scramble. This could cause a violent exponential spike in the paper price as it desperately tries to catch up to the physical reality in a matter of days or hours. The coiled spring releases. Each scenario has different implications. The first is a validation of fundamental analysis. The second is a fracturing of the global pricing mechanism. The third is a disruptive historic repricing event. None involve advice. They are simply the possible endings to a story that begins with a single stark fact: a 250% surge in demand for something that cannot be printed, in a system built on the trading of promises. The bounce back in physical demand is real. What happens next is a test of the system itself.